My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Even on good days like today, this market's treacherous. Opening week again, driving people out, then finishing strong. Dow ultimately gaining 565 points, S&P rising 2.43%, and the Nasdaq jumping 3.13%. Oh, this one whipsaws you every day. And just when you think you got the new pattern figured out, well, it just smashes it to pieces. And you know what? On Fridays in bear markets, the shorts cover their positions in case something positive happens over the weekend. This is a pattern that almost all of the bear markets I have studied and traded through maintain. So get used to some very interesting positive Fridays. In this wild environment where everybody's laser focused on the Federal Reserve and not the fundamentals, you have to ask yourself, can the stocks of individual companies even matter? Sure, if they're good enough. The stock of Apple. Well, that surely buoyed the market with that incredible number last night, reminding us why we like to own stocks in the first place. You might have forgotten what it feels like to make money as we just completed an amazing period. 10 days where the losers outnumbered the winners every session. The longest period of disappointment in 20 years.
The House of Pain.
At the same time, yesterday, that S&P oscillator I talk about, the one that I followed since 1985, it hit minus 10, the most oversold reading since the crash at the start of the pandemic. It's almost always been a buy at down 10. Now, whenever we get that oversold, I remind you to hold your nose and buy, and that's what I've been saying to you. Sure enough, it triggered a nice rebound today. Remember, though, you need to use the strength that we're going to be getting to lighten up on the conceptual stocks. As the Fed turns, you need to stick with the stocks of tangible companies that make things and do stuff at a profit. And which ones might they be? Well, why don't we go to our game plan to figure things out? Now, next Monday morning, we get results from the classic kind of company I'm talking about that makes things and do stuff called Otis Worldwide. That's the elevator company spin-off of the old United Technologies. We have to hear whether there's finally a slowdown in China. Caterpillar hinted that there is. And we also want to know how the U.S. is holding up. CEO Judy Marks has this venerable machine humming. I think she's got a terrific pulse on large-scale construction worldwide. Her numbers are spectacular. After the close, NXP Semiconductor reports, and you probably never know these guys, but this is the most crucial choke point in the auto industry. Yeah, they make the chips for the autos. Can they meet demand in 2022? I sure hope so. NXP's also got really excellent near-field communications technology. That's the technology that lets you use your cell phone as a credit card. If Apple's going to go up against Square in that field, then NXP might be a logical partner. Let's listen. Tuesday morning, we hear from Exxon. Now that new people are getting comfortable owning the oils, and you know I think you should, you need to know that oil and gas accounting can be notoriously difficult, something that misled the people who sold the stock of Chevron today on an alleged miss that was really much more of a depreciation issue. I hope you bought and didn't sell. I fear Exxon could face a similar affliction. It takes down the whole oil patch with a so-so number, then that's your chance to buy the best of breed, which is, again, Chevron, as we regularly tell club members, including today, in a regular morning meeting at 10:20 a.m. After the close, we have a controversial set of quarters. First, the Alphabet reports that this market can have such high standards. Sometimes even a terrific quarter generates no interest whatsoever. I wouldn't be surprised if Alphabet delivers just that. My suggestion, look, if it's really good, put it on your shopping list. Wait for the next market-wide swoon. It won't be long in coming. It's like a bus. Do you know that AMD, which also reports next Tuesday night, is down 27% since the year began? That's horrible. This despite the fact they just got permission to buy Xilinx. Positive. Owning AMD can be a tough chore at times. The stock's prone to cliff jumping, but that usually turns out to be a bungee jump, and you end up even higher than where you started. My take, buy some. We own it for the travel trust. As I said in the morning meeting, I think the decline in AMD is wrong-headed. As I see it, AMD's gotten way too cheap on its 2022 numbers. There was a seller out there today who was such an idiot that he tested Jimmy Chill's patience. Then there's PayPal. Talking about testing my patience. A great company with a stock that's become a total house of pain, especially for me because we own it for the travel trust. They can't all be winners, where it's a source of tremendous anguish for me. I like call it pay friend at home. I don't want to call it PayPal. Some friend of mine. No buddy pal friend of mine. Anyway, PayPal's been cut in half, and I feel that. And it's still being punished, a sign that buyers have had it with growth and would rather own Bob, which I call, that's boring old bank. I came up with that today. Let's see if CEO Dan Schulman can say something that will get investors interested in remembering why it's okay to own growth again. Don't hold your breath, though, because new fintech is really hated as much as old fintech, look at Visa, is loved. Could this be the quarter when people realize how cheap the stock of General Motors has gotten? If the market has truly turned to value, I mean, geez, this should be GM's moment. It just ain't that bad. Still one more on a tough day, Starbucks. Will they address the unionizing effort, qualifying how it's really going? How about the impact of Omicron on store hours and shifts? Has the China lockdown pre-Olympics hurt them at all? These are some of the reasons why Starbucks stock is now down 17% for the year. Hopefully they can quantify the pain and limit the damage. Wednesday, we hear from Meta Platforms, the company formerly known as Facebook. The stock seems very cheap on 2022 earnings. This is a company that's been consistent for quite a stretch. And for once, it doesn't seem to be attracting much criticism for its business practices. I think some of that is because it's helping small businesses a lot be able to develop their own businesses on Instagram. I think Facebook is worth owning, both for the digital advertising and for the metaverse. AbbVie, company you don't think of, but it's a $240 billion drug stock, reports. It's got a lot of new drugs. It yields 4.1%. I think it's run so much that you might as well wait before you buy any here. But I do expect AbbVie to have a good year. In another earnings period, I might tell you to be bold and buy it ahead of the quarter. But this has not been a great moment for boldness. Yes, the future does not belong to the... Oh, well, you know, you get the picture. You know what? We're really at a Falstaff market here. Discretion, better part of valor. Now, on Thursday, we hear from a pair of stocks that I've been recommending to Investing Club members, Eli Lilly and Honeywell. That's because I expect both to lay out their plans for a pair of transformative years. Lilly's got huge drugs for Alzheimer's and diabetes in its pipeline. Honeywell's got an enormous aerospace business that I believe is turning. Meanwhile, the stock is a total dud. It hasn't stayed a dud for a very long time. Stay tuned. Darius Adamczyk will do something good for us. After the close, Ford reports, and while Tesla claims to have millions of orders for its new pickup that doesn't yet exist, I think 2022 is Ford's year. It's building quite an electric vehicle following. They could tell us all about the battery-powered F-150 Lightning, arguably the most exciting new offering from Ford in decades. Then there's Amazon, a once Starling member of FANG that now seems to have completely lost its luster. People come on TV, they're like proud they sold it. Oh, hey, listen, I got out of Amazon. Whoa. Anyway, Amazon's the poster child for the kind of stock this market does hate, inconsistent high growth. I remain a believer because I'm going to overlook this particular period. Why? Amazon Retail, Amazon Web Services, Amazon Advertising is why. And those are all terrific entries. They're great businesses. But again, I think you have to be patient. You have to take some hits. You have to be willing to get hit over the head. Wait until you see the quarter before you buy. Do not buy this stock ahead of the quarter. I think you could be hurt. I just don't want you to get hurt. After all, Apple reported an incredible quarter last night. You know, you still got a chance to buy it at 162, 163. It went out at 170. Finally, even as next week hasn't even started yet, Friday can't come fast enough. And I'm looking for Regeneron to tell a good story. It sells at 11 times earnings. That's a little nutty. And it's not because of COVID. It's for new drugs for asthma, among other afflictions. You know what? It's also time for Bristol Myers to stand up and be counted. They got to tell us something new about the drugs that it picked up when it bought Celgene. And then really, where's the $13 billion myocardial numbers? I think shareholders might like what they hear, but they got to hear it first. The bottom line. Next week is the last truly hard week of earnings season, the last week where analysts have to jump from call to call just to stay on top of the companies they cover. I say each day will be controlled, not by earnings, but by the wild action in the S&P futures, which is all related to Jay Powell. So have your buys ready for those hideous, nauseous moments, because I got to tell you something. I bet there will be plenty more ahead. Luca in Texas, Luca.
The OG Jimmy Chill. Booyah.
Booyah, my friend. Booyah. Best day of the year. We're happy. What's happening?
Yeah, I appreciate everything you do for us. This stock was high as $1,700 back in November. Today, I lost almost 1,000 points. I'm sure the business model hasn't changed. My question is on Shopify.
Okay.
Buy it.
Yeah, I think Shopify. There have been people who say that had a downtick. They had to close some fulfillment centers. I think they should come on and just tell us if it's true. And if they didn't, then you buy. But until we hear, let's powder dry. All right, next week is the last hard week of earnings season. I think each day will be controlled by swings in the S&P futures, which are controlled by people talking about how many interest rates they're going to have, not by earnings. Hike, earnings. I'm going to do some stuff with the football next week, remind me. So get your buys ready for these hideous moments. On Mad Money tonight, Wall Street trampled over Boot Barn today after earnings. But should investors think twice before giving it the boot? I'm digging into the Western wear retailer, and now I'm just calling it a regional national clothing company, CPO. Then, a volatile market like the one we've had this week, perfect reminder to have a defensive portfolio, not just a bunch of call options in Dogecoin, and that's why I'm playing in my diversified. You want supply chain management? How about Rockwell Automation? Stock fell today after reporting a top and bottom line beat. Are investors getting a chance to buy here? You know what? Let's talk to the CEO and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.